Welcome to Video 20B on forming a partnership. So acquiring partnership interests when partnerships are formed. So what is a partnership interest? Partnership interest is really just another term for an ownership of a partnership. So when a partnership is formed, partners can transfer cash, tangible, intangible property, or services in exchange for a partnership interest. So partnership rights generally allow them to receive a share of the partnership assets if the partnership were to liquidate. That's called a capital interest. Or the right or obligation to receive a share of future profits or losses. That's called a profits interest. So we've got capital interests and profits interests. Partners who contribute services instead of property often only receive a profits interest as opposed to a capital interest. So contributions of property, depending on the transaction, often result in realized gains and losses. However, generally speaking, if that property is contributed to a partnership, that realized gain or loss is generally deferred, or at least partially deferred. And what you're going to see is that the rules are very similar to a 351 exchange that we covered in the last module. So generally, neither the partnership nor partners recognize gain or loss when they contribute property to partnerships. The definition of property, like with 351, is broad, includes a lot of different assets, but obviously not services. And the general rule facilitates the contribution of property with a built-in gain, and it discourages the contribution of property with a built-in loss. The reason being is that that loss is not recognized, it's deferred. So as a result, sometimes it makes more sense to actually sell that property and then contribute the cash so that the loss can be recognized. Okay, so we're going to talk initially here about basis. We're going to loop back around to this in a couple videos, but we need to get started. So a partner's initial tax basis, which is we need to calculate tax basis for a number of reasons, one of which is if a partner sells their partnership interest, of course, what is the amount they get back tax-free? So a partner's initial tax basis when the partnership doesn't have any debts is simply the sum of the tax basis of the property and cash that was contributed. So we have the same sort of carryover of basis that we saw under 351 corporate organizations. So Patrick, SpongeBob, Mr. Krabs organized the Krusty Krab Partnership in 2018. SpongeBob contributes $10,000 of cash and land with a market value of $110,000, and the land has an adjusted basis of $20,000, and all that gets contributed to the partnership. Whereas Patrick and Mr. Krabs both contribute $120,000 each in cash. So when we calculate the basis for SpongeBob, well, the cash is always at basis, so that's $10,000, and the land he contributes, he gets basis that matches the basis of the land he contributed, or $20,000. Therefore, his total basis is $30,000. So the fair market value is not relevant. This is in spite of the fact that, of course, SpongeBob realizes a gain of $90,000, right? So what does he receive in exchange? Well, he gets $110,000 fair market value of partnership interest in exchange for his land with an adjusted basis of 20. That's a realized gain of 90, but no gain will be recognized by any contributing partner in this transaction. So Patrick and Mr. Krabs, they both just get partnership interest in exchange for their cash. So if the partnership has debt, then the computation of the partner's initial tax basis can change a little bit. So each partner needs to include his or her share of partnership debt in calculating basis, and you'll recall we covered this back in Chapter 7 just briefly. And the outside basis of a partner contributing property must also reflect the partner's debt relief and any gain that might be recognized from debt relief. Okay, so let's do some examples. Well, not yet. So a partnership can have recourse debt or it can have non-recourse debt. So we've discussed these as well. Recourse debt is debt that the partners are liable for, right? They have economic risk of loss. Generally speaking, that's going to be allocated to the partner who will ultimately be responsible for paying it. And a partnership can also have non-recourse debt, which is, of course, generally secured by property within the partnership itself, but they can't go after the partners for that. The bank doesn't have recourse against them. And that's usually just allocated according to the partner's profit-sharing ratios. So a partner's contributing property secured by debt will force a recognition of gain if the debt relief exceeds the partner's basis in his or her partnership interest before debt relief. The contributing partner's holding period in the partnership interest generally depends on the type of property contributed. So for example, if it's capital property, then the holding period carries over. If it's ordinary property, then it starts at the date of the contribution. The contributing partner's tax basis and holding period, as I just stated, carry over to the partnership. Okay, so Patrick, SpongeBob, and Mr. Krabs organized the Krusty Krab partnership in 2018. SpongeBob contributes $10,000 of cash, and get out of the pool, Richardson.
There's no pool in this pool.
Out of the pool, let's go.
No can do, Dave.
Come on, Richardson. You're being a tool, man.
There's no tool in this pool, and I'd happily get out if you let me join your crew.
Can't join the crew, Richardson. You don't do anything.
Oh, don't I? You like what you see?
Patrick, SpongeBob, and Mr. Krabs organized Krusty Krab partnership in 2018. SpongeBob contributed $10,000 of cash and land with a fair market value of $110, adjusted basis of $20. Patrick and Krabs both contribute $120,000, and now immediately after the formation, the partnership borrows $60,000 in recourse debt. So you can see that the basis would be calculated the same for all three partners, except in this case, the debt creates additional basis to them. So one way of thinking about this, and we'll cover this again in a few videos when we do basis one more time, is to think about the partnership taking on debt as the partner borrowing money and then contributing that cash to the partnership. Because economically they're the same. The partnership borrows debt, it's recourse debt, the partners are liable. They consider that a deemed contribution of cash. And that's exactly how a deemed contribution would be treated. So SpongeBob again realizes the $90,000 a gain, but no gain is recognized by any contributing partner. Okay, so in this case, Patrick, SpongeBob, Mr. Krabs organized the partnership. SpongeBob contributes $10,000 of cash, land with a fair market value of $150,000 and adjusted basis of $20,000. In this case, the land was encumbered by a $40,000 non-recourse mortgage, and it was executed a number of years ago, and that's important from the perspective of it wasn't for a tax shelter. So Patrick and Mr. Krabs both contribute their $120,000 in cash, and immediately after they borrow the $60,000 of recourse debt. Okay, so let's march through first SpongeBob. So SpongeBob gets basis for the $10,000 in cash. He gets basis for the $20,000 in land. In this case, the amount of debt that was attached to the basis of that property is in excess. And so $20,000 of that gets baked into his basis. The remaining non-recourse debt, so there's an additional $20,000 of that non-recourse debt that's going to be divided evenly amongst the three of them. So you can see they all get $6,666. Then there's the $60,000 of bank debt. And then lastly, SpongeBob enjoys debt relief, and that affects his basis because obviously he's being relieved of debt. And again, that's treated as a deemed distribution of cash. And a distribution of cash lowers your basis. So as a result, you can recalculate the total basis for each of these partners. Okay, one last go here. So in this case, everything is the same as the last, except this time Patrick and Krabs, but not SpongeBob, personally guarantee all $100,000 of the Krusty Krab's debt. So that's the bank loan, and it includes the $40,000 mortgage on the land. So now what is any gain and any basis for these partners? So in this case, because the debt relief that SpongeBob receives is greater than the basis he had in the property he contributed, he's going to be required to recognize a gain of $10,000. So let me see if I can paint that picture for you. So he has debt relief of $40,000, and he has basis of $10,000 in cash and $20,000 in the land. That leaves him $10,000 of gain to be recognized. And that's just the way the rule works. And so what we end up with is SpongeBob has no basis in his partnership interest at all. Patrick and Mr. Krabs both take all the basis in the debt, they split it evenly, and they end up with $170,000 in basis each. So if there's a partner that contributes services, so typically, again, contribution of services does not result in a capital interest. It often results in only a profits interest. But remember that a capital interest represents an economic entitlement that is amenable to measurement. So what that means is you're getting some future cash flow that you should be able to estimate. So service partners that receive a capital interest generally report ordinary income, and their tax basis is the amount of income they recognize. Whereas a profits interest, no one really knows what the future profits are going to be. They could be a lot, they could be a little, they could be negative. So as a result, there's generally no liquidation value to a profits interest, and the service partner does not recognize income in exchange for just a profits interest, which, as you'll recall, that's typically what they get. So on the last day of the year, Patrick and Krabs agree that SpongeBob will receive an additional capital interest with a liquidation value of $20,000. So they've estimated that whatever this capital interest is worth, if they were to liquidate the partnership, SpongeBob would end up with $20,000 more. So in order to do that, they're going to increase, not her, but his profit and loss sharing ratio from 33 1/3 to 40%. So to compensate SpongeBob for the time he's going to spend on some project, maybe he's developing the Krabby Patty formula. And if at this point the Krusty Krab partnership's debt was $100,000, what are the tax consequences? So here's what the tax consequences look like, right? So SpongeBob picks up the ordinary income for his capital interest. And Patrick and Krabs, obviously they have to give something up. And what they're giving up is a share of their interest in the partnership. And so as a result, they get a deduction for that amount. So the tax basis of a purchased partnership interest is much easier than when one is formed. So let's say I decided to just outright purchase SpongeBob's interest from him. Now it's just the purchase price that I pay plus any partnership debt allocated to me. And the holding period begins on the purchase date. So it's like buying a share of stock in a way. Okay, here's a great summary from the book. I encourage you to take a peek at this when you get a sec. And that brings us to the end of Video 20B. Thanks for watching.
Kevin, did we reinforce the takeoff ramp?
No, we didn't have time.
Cool. Soul of an eagle. Oh, shit. Are you okay?